This is our project for BPA Economic Research 160. This is our team. This is Harkeerat Singh, I'm Himanth Reddy, and that's Sriman Yalamati.
This is our agenda for today.
Monetary policy is a crucial economic tool that is used to manage the supply of money and keep the economy stable. The governmental entity responsible for monetary policies are central banks. Central banks are crucial for the modern banking system and modern-day society. They are financial institutions responsible for forming monetary policy, regulating member banks, and using operations to manage the flow of money in a country's economy to prevent economic outbursts such as inflation and deflation.
Central banks use monetary policy to manage the economy and meet the set goals and requirements concerning it. One of the major goals is price stability. Another is stable exchange rates. Monetary policy plays a key role in keeping the exchange rate between foreign markets stable. A stable exchange rate leads to dangerous markets for investors. Countries with lower interest rates don't usually trade with countries with higher interest rates, which leads to economic hardships for countries with lower interest rates. In the USA, the 12 members of the FOMC set goals and try to accomplish them for the betterment of the economy.
Next up, we have tools. There are a multitude of tools used, but we'll only discuss 9 of the major tools used today. Open market operations are when the Federal Reserve System purchases treasuries on the open market. This affects short-term interest rates, which influence long-term interest rates. Buying treasuries and securities injects liquidity into the banking system, while selling them decreases it. Reserve requirements are the amount of funds a bank must hold to ensure it can meet liabilities. An increase in requirements forces banks to purchase temporary liquidity from the central bank, raising their costs and reducing their lending activity, lowering the public's deposits. Asset purchases are lower interest rates on free risk-free assets across different terms to maturity of those assets. By buying assets, the bank stimulates the economy.
Inflation is the rate of increase in prices over a given period of time. Usually there is a low rate because a low rate allows the economy to grow. Policy rate is a broad term generally used to define the target inflation rate of federal funds rate, but can never have different meanings based on where it is used. This tool affects several factors. Unemployment acts as an expansionary monetary policy tool because increasing unemployment results in a higher money supply and attractive interest rates. This ends up stimulating businesses and increasing the job market.
The federal funds rate is a short-term often overnight rate that banks charge whenever to borrow funds. The discount rate is the interest rate at which commercial banks and other depository institutions can borrow reserves from regional Federal Reserve banks to facilitate short-term adjustments to temporary changes in the structure of their assets and liabilities. The interest rate is a broad term that defines many things, like the cost of borrowing money and return on investment, for example. The interest rate is generally expressed as a percentage of the total borrowed and is set by central banks.
There are many advantages and disadvantages for central banks and monetary policy. One advantage is price stability, which causes high morale and a safe economy, leading people to spend and invest. Central banks also have a positive effect on long-term interest rates by manipulating short-term interest rates and leading people to make assumptions that the central bank want them to make. Central banks can also have many disadvantages. Sometimes it can be ineffective during deflation, since deflation tends to be harder to control because central banks can only lower their policy rates close to zero. As a result, some banks have opted for negative interest rates. This is when the banks lend out money so that they can earn back at an interest. When interest rates are low and savings are high, this leads to a liquidity trap, which makes monetary policies useless. During this period, consumers usually avoid buying securities and instead start putting money in a savings. If a bank tries to increase interest rates, bond prices decrease. The irredeemability of fiscal paths pose significant challenges to monetary and financial stability. This is largely because monetary policies often react to fiscal changes with a delay, as economic signals take time to respond to policy adjustments. This can lead to investors making incorrect assumptions within the lag that hurt the economy. Regardless of the many disadvantages and advantages, monetary policy still remains effective and essential to everyday marketing and banking.
As economies evolve, the connection between monetary policy tools and economic indicators can shift, meaning central banks may need to continuously adjust their strategies to remain effective. It's important to note that these institutions often face political pressures that complicate matters, especially during tough economic times. Therefore, they must communicate any nuanced policy changes in clear and transparent ways to both the public and the markets.
There are still several future opportunities. An example is the development of the CBDC, which can modernize payment systems and enhance the implementation of monetary policy. By improving data collection analysis, central banks can make better decisions and respond more quickly to changing conditions. These institutions may explore innovative policy tools such as yield curve control and targeted asset purchases to effectively influence economic conditions. Additionally, they can establish mechanisms to measure and mitigate systematic risk while striving to fulfill their dual goals of ensuring employment stability and maintaining price stability. While monetary policy and central banks are not bereft of challenges, this centrality of their role is inevitably part of the economic management. This way, constant reframing of the approach and mitigation of monetary tool limitations is dynamically changing global economy, help central banks succeed in fostering stability and growth. Thank you.
Thank you for your time.